Welcome to Stifel's Sightlines podcast, focusing each week on a topic or two important to investors. Well, greetings and welcome to the Sightlines podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. In this session, I basically want to get into the idea of the normalization of the kind of data we watch to monitor the macro market environment. And to kind of take a step back, back when we were in the pandemic, when we had such significant job losses and high inflation and a quick, deep decline in economic growth and then a quick recovery, everybody was working on the data. The only way to sort of come to terms with what was going on, the magnitude of it, was to talk about it in terms of distortions and how non-normal or abnormal it was. And so finally, 5 years hence, we're sitting here and realizing in monitoring, obviously, that the data itself is starting to normalize. And I kind of think of it as looking like levels and amounts and information we can respond to like we used to do before the pandemic. And so I literally have some analytics that we do where we kind of cut out the pandemic block so we can sort of look at how things typically move around and how the current environment might compare to past environments and all that. So anyway, we want to get into that with a few specific details. So, and this is really in some ways a precursor to next week's Fed meeting. So it's an interesting situation. The Fed has a dual mandate, basically focus on, maximizing jobs, so a good labor market, but at the same time, reasonable prices. And so inflation is something that they're very focused on with their sort of classic 2% target. And so if we unpack some of the data, we're seeing first in the labor market, basically take, for example, the JOLTS report, 7.4 million job openings in the month of May. So think of it as job openings. And when we look back to the 10 years prior to the pandemic, that number is averaged 5 million. And so that is one data point, which I think is a pretty meaningful one. It's pretty comprehensive. That is pretty positive, right? It's telling us that the labor market's in a pretty good spot. Now, I'm going to talk about two other data points that maybe aren't quite so positive. The first is the non-farm payrolls, and think of this as incremental. Anyway, in May, 139,000 payrolls. And basically, when we look back over the last decade prior to the pandemic, the average was actually 183,000. So that's one piece of data that is a little bit softer. And then finally, a data source that is not necessarily looked at extensively, but it's in the media, so I wanted to mention it, is ADP. So this company can basically monitor payrolls based on their businesses, right, that they're tracking. And there was an increase of 37,000. And so, basically, when we look at the pre-pandemic average, it was 168,000. So that's a particularly soft piece of data. It got a little bit of media attention. But the punchline is, when it comes to sort of openings and whatnot, it still feels like the labor market's in a pretty decent spot. And that's reflected, for example, in the unemployment rate. Two other points of data. One is unemployment at 4.2%. The pre-pandemic average for the 10 years prior was 6.2. So by unemployment standards, things are pretty good. The JOLTS quits rate, basically, this is one that has normalized. It basically has fallen to 2%. So 2% of the workforce looking to change jobs, making decisions to change jobs. And that's right in line with the 10-year pre-pandemic average. And so all that to say, and I think the important thing is the job market seems to be holding up okay for that part of the Fed's dual mandate. Another metric which sort of gives us the transition to inflation is wage growth. Wage growth over the last year was 3.9%, so almost 4%. The 10-year average prior to the pandemic, a 2.4% year-over-year level on average. And so, again, firmer wage growth, which often is associated, this idea that people are growing their earnings, therefore they can spend more, the demand goes up, and that could be a pressure on inflation. But, and it's kind of a big but, as we look at the inflation reports that are coming out, they've cooled. So, for example, the consumer price index in May was up 0.1%. And what I've been trying to do is sort of look at sort of rolling periods to sort of get a sense for whether we're seeing data sustained. And so when we look at, for example, the last 4 months ending May, the annualized rate of inflation was 1.4%. So meaning if those 4 months are repeated over and over, we're going to have an inflation of about 1.4%, which is basically, well below the Fed's 2% target. And when we take out food and energy, it's very common to do that and look at core CPI. That 4-month period basically rises right to the Fed's 2% target. So for the last 4 months, core CPI has been sitting right on top of the annualized rate of 2%. And that's really good news. It's like we've been waiting for this. Now, candidly, we're about an hour as I record this from getting the producer price index. So we'll see where that falls. But my instinct is that will similarly show, especially over these last 4 months, the very muted levels. And then PCE, which takes a little longer to come out, basically, so we can look at the last 3 months. So we just have data through April, but so if we want to lock in on that same period, but we're waiting on May, the last 3 months has an annualized rate of 2.1%. So all that to say, at least in a localized focus, last 3 to 4 months, essentially inflation has cooled right down on top of the Fed's 2% target. And so the Fed's watching for tariff pressure. There's uncertainty about it, but it hasn't yet shown itself. Now, turning to the Fed, so think of it as, again, firmer job market basically means they can hold rates steady. Cooling inflation gives them an excuse to cut. And yet, when officials are out there, they're signaling their intention to stay pat, basically to leave rates unchanged, leave policy unchanged because of the uncertainty of tariffs and trade, et cetera, et cetera. And just to round it out, I'll give you one quote from the Atlanta Fed president, Raphael Bostic, who recently said, quote, "Given the elevated uncertainty, I continue to believe the best approach for monetary policy is patience. The economy remains broadly healthy, giving us space to wait and see how heightened uncertainty affects employment and prices," end quote. So the punchline is, again, and there's speeches all over the place where most Fed officials are signaling a consistent message as it relates to that. In any event, just to round it out, I'll just come back to where we started. The good news about all this, in a way, is we had a bunch of distortions in data through the pandemic and in the wake of the pandemic, as reopenings occurred and demand kicked up and inflation kicked up. But we're finally getting to a point of normalization where the data is kind of coming back down and sort of acting as it did prior to the pandemic, which is really helpful because it helps us just understand in a more normal environment, to reuse that word, that things are easier to basically process. And right now, candidly, despite all the uncertainty, things are holding up well. So we've got, sort of a sense that the economy continues to grow, and with the potential for a pretty positive print in second quarter to kind of swing away from some of the negative forces in the first quarter. And then we've had, generally speaking, a recovering stock market. And so, again, more to talk about for sure. In any event, I want to thank you for taking the time to listen to this session, and we'll catch you on the next episode. Thanks so much.
Thanks again for listening to Stifel's Sightlines. Be sure to subscribe wherever you're listening to automatically receive each week's podcast in your feed.